Hello and welcome. Good evening to all. Once again, thank you for joining. And today's topic is RBI interest rate hike and how to invest. Hi, hello. Thanks for joining. Thanks for joining. Hi, Rajesh. Great. So we have been seeing in the news, I believe, about this RBI interest rate hike, and uh, it was sudden, in fact, uh, not planned, and it came right in the middle of the, just after one day of the LIC IPO starting, and took the market by surprise, and the market reacted negatively. Uh, so just to update ourselves as to what is this interest rate hike and how does it impact the market, and as an investor, what are the steps that we should be taking, what are the things that we should be careful about, is what we are looking at today. So this is just a general finance topic, and it'll be a short session. Just a few guidelines on how to invest in a high interest rate scenario. The disclaimer at first: I'm not a SEBI registered analyst, so whatever discussions we are doing here, they are not investing or trading recommendations, just purely intended for educational purpose. Okay. So so this is what we'll be discussing: the RBI rate hike. What is it, in fact, and why was it necessary? And then we'll also go and see what is the impact and the action, or how will this impact the market, and what is the action that we need to take, what is the investing strategy that we need to follow. So just the basics of what it is, and how it will impact us. So this is what it is: the RBI rate hike. The RBI has increased the repo rate. The repo rate is the interest that is charged by the RBI to the banks. So the banks, when they have some cash crunch or some kind of a liquidity problem, they go and approach the RBI. They borrow money from the RBI, and the RBI gives them money on a particular interest rate, and that rate is known as the repo rate. Okay. And for the banks also have to submit some kind of a collateral. So usually they submit some kind of government securities or something as the collateral, and the RBI gives them money on which they are supposed to pay interest. Now this interest was at 4% for quite a long time, but now it is increased by 40 basis points. 40 basis points is nothing but 0.4%. So it is hiked by 40 basis points to 4.4%. Okay. And this is an unexpected hike, in the sense that it was not planned. Normally they have this monetary policy meetings, and they had one in the last month, right? So it was expected that maybe they will do something, uh, they'll increase the rate or something. But in last month they didn't do anything. When just in the middle of in the middle of the LIC IPO, they suddenly brought on this rate hike. And there's another meeting that is expected in June. Yes, we should expect more rate hikes. So further hike is likely, because another meeting is already scheduled in June. And so that's why I was saying, because RBI has just gone on, unscheduled and unplanned, and just came out with this rate hike. So it took the market by surprise in that way. But looks like, because they were, it was kind of an emergency, and was kind of, they had to react to some, to the hike in the US interest rates, and also the inflation, which was going beyond the control. So they had to do something, and that is why they hike, this hike in the unscheduled hike. But this is not going to stop here. So there is going to be a further hike, in June. We can expect a further hike in June, because the Federal Reserve of US has already said that over the next year, over the next few quarters, they will increase rates by at least 50 basis points. So if US is going to increase rates because of the inflation of their country, right, we will also be compelled to do so. And so therefore further hike is likely to happen in the Indian market also. RBI is going to hike it. Yeah, so right now inflation, that's right. So this is one way of managing inflation. So if oil prices fall and key commodities remain stable, as of now, does not seem to be likely low, given the war situation, given what is happening in China, things like that. There's a lot of supply disruptions happening. So as of now, we are not able to foresee any kind of a any kind of a easing off, and especially food inflation is the one that has taken it beyond control. So the primary reason for this unscheduled hike was food inflation. So so it has gone beyond the tolerance limit of 6%. 6% is the tolerance limit of RBI, and it has stayed beyond 6% for I think a couple of months, and that is why they had to come in and intervene in the before the actual meeting is happening. The meeting is going to happen next month in June, and before the actual meeting happened, they had to come in and intervene. So yeah, if the prices fall and all of this is happen, maybe they will not. But as of now, we are not able to foresee any such thing. Even if the prices fall and inflation becomes stable, it will not happen. In the immediate future, right? It may take around 1 or 2 quarters for that to happen. And because we are a globally tied economy, right, because something is happening in US and the global markets, we are also tied to it. So and this is a scenario that is happening all across the world. And so therefore in the near future it is unlikely to be. So this stability we can expect in a couple of quarters. So further hike is definitely likely to happen. Yeah, so RBI has increasing interest rate primarily to control inflation and suck out the excess liquidity in the market. So there is this something. There's another thing which is known as the cash reserve ratio, the CRR. So this is a percentage of the total deposits that the banks have to keep with the RBI. They don't get any interest on this. That is also hiked by 50 basis points. That is 0.5% to 4.5%. So any excess money supply with the banks, the RBI is sucking it out by the CRR and by both of these measures together. It is sucking out the liquidity in the market. So what is happening is that because there is excess liquidity in the market because of what all the the monetary supply and all, the printing of money and all. So what is happening? Demand is increasing, prices are going up. So now RBI is trying to suck out the liquidity, the excess liquidity, which is with the banks and within the economy in general. They are trying to suck it out, so that demand would come down and prices would become more stable. And by increasing the rates, they are also increasing the cost of borrowing. So people who are wanting to borrow, they will also find it a little bit more expensive. Why was it necessary? Yeah, that's your question. So why was it necessary? The sharp rise in inflation to 7%. Right. Chart analysis will be doom and gloom definitely, unless there is some kind of a reversal candle coming up. We'll have a doom and gloom chart analysis. Right. That's right. We'll see that on Wednesday. House and vehicle loans will become more expensive. Yes. Sharp rise in inflation to 7%, which is beyond the tolerance limit of RBI. RBI had a tolerance limit of 6%. So the inflation is showing 7% for at least a couple of months now. That's the reason that it was becoming extremely necessary to bring in the rate hikes. So when the rate RBI has increased the rate, so what will happen? The cost of borrowing and the cost of funds for the banks will also increase. They will have to increase the fixed deposit rates, and they will also have to increase the lending rate. So your housing loan, vehicle loan, any kind of loan is going to increase. The rate is going to increase. Yeah, they might have already increased. In fact, you should have got a mail from your bank till now, because they are very fast when it comes to increasing rates, but when it comes to decreasing, they are pretty slow. So you should have already received a mail. In fact, if you're not, then in the near future you will, because the increase in the rates is definitely bound to come. So the another reason is, apart from inflation, there is another reason, and that is that the US Fed, like we were talking, the US Federal Reserve has also hiked the rates. So what is happening is that because the bond yield, the bond yields of the the interest rates on the bonds of the government bonds in US is rising, and so therefore that is your free risk-free return, right? So the foreign investors, the foreign institutional investors, because they are getting a higher risk-free return in dollar terms, they will move their money from the emerging markets to the they will have to allocate some more money to the bonds, right? They have to manage their portfolio. And so what will happen is that, in rupee terms, our rates are not rising, but in dollar terms their rates are already rising. So what will happen is that the institutional investors will withdraw money from our market, from the government bonds here, and the spread will decrease, and so they will take it over there. So the spread has to be maintained. So if they are increasing the rates, we also have to increase the rate, because our currency is also not stable, it is depreciating. So in that sense, the you know the institutional investors will quickly, they'll be prompted to move out from the emerging markets. So that is also one of the reasons. So if the US Fed has hiked the rates, it is also necessary for us to for us to hike the rate. It looks unlikely that inflation will correct anytime soon. Suresh, my assessment is that, our stability would take at least 2 quarters. Yeah, so 6 months is what I think. The economy should become stable because of all these measures. One more rate hike is due in June, and so the effect of which we will be able to see in the next and the forthcoming quarter. And by that time, people will be able to adjust. Corporates, companies will be able to adjust, and things like that. So at least 6 months is my view, that, for coping with the inflation, coping with the new hike in the interest rate regime. So in another 6 months we'll be able to see the result of this. So CRR, just like I said, it's sucking out 87,000 crore liquidity from the system. So there is around 7 lakh crore odd, around that figure, liquidity in the system, out of which 87,000 crore is being sucked out just by the CRR. So because banks have to place this money with the RBI. So this is why it was necessary, and excess liquidity is being sucked out, so that demand would come down and prices would come down and things would become a little more stable. The economic growth, as the India growth story is much robust, is a very robust economy. So we have seen this high inflation a lot of times in the past, and we have managed to come out of it. So as economic growth in the long term is not is not going to be affected so much, but in the near term we have to deal with this, right? In the near term we have to deal with the things that are happening here, price rise, things like that. And ultimately, when price rise happens, ultimately then employees will demand more salary, so there'll be wage price, and then it's a vicious circle, it goes on. So it has to be managed, right? So once that management takes place, I think the corporate India is strong enough to sustain all these pressures, and eventually it will come out. In another 6 months we'll be able to see what is coming out, and I think the long-term growth is not going to be hampered. But these are short-term pressures that we have to deal with, right? So so what is the impact? This is the impact, like we already discussed. Your house loans, your vehicle loans, any other loans, interest rates on the loans will rise. At the same time, interest rates on the deposits will also rise, right? So what is happening is that because interest rates on deposit will rise, many people will move out money from the equity market. The equity market is going down, so many people will move out money from the equity market, and they will put it into fixed deposits. Yeah, they will put it into some kind of bonds, or because the interest rates will rise over there. So again, it is a matter of sucking out the liquidity, right? So and that excess liquidity will go to the banks and eventually to the RBI and out of the system. So interest rates on deposits will rise, and interest rates on the loans will rise. This is the primary impact for us as a as a common person, as a common man. It is the primary impact upon us. Fixed deposits and saving accounts, no, Krishna, they are still not a good investment unless it is the emergency money, right? If it is your emergency fund, then it is okay. But fixed deposits, you see the inflation is hovering around 7%, right? And the I think the wholesale inflation is much more than that. So this is the CPI, the consumer inflation is 7%. and I don't know the wholesale inflation figure, but I think it is much more than that. And so you are getting your fixed deposit interest is your 5%, or maybe now it will be increased a little more. So approximately 5%, 6%, whatever. So what are you losing? You are losing 2% in real terms, right? Your inflation is 7%. You're getting 5%. You're losing 2% in real terms. So in an inflationary scenario, bonds and fixed deposits and things that are, they can be a safe haven. You're not going to lose money in the sense, no, in nominal terms you're not going to lose money, but in real terms, because of inflation, the purchasing power goes down, and therefore in real terms you lose money. And that's why only your emergency funds and things like that can be put in fixed deposits. But otherwise this is a difficult time to navigate uh, our investments. Okay, this is a difficult time to navigate because everything is going down at the same time, right? Equity market also going down, and fixed deposits not giving you real returns, and then debt markets also, long-term bonds and gilts will go down because the interest rate hikes. So that it's a difficult market to navigate. We need to navigate for this another quarters, or maybe 3 quarters max, and then we'll be able to see some movement. So uh, 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 so uh, there's a negative impact on the equity due to greater allocation towards bonds. Like I said, market will move towards bonds. They will move towards fixed interest bonds. And you're asking what is a good investment? Is fixed deposit good? Shorter terms bonds are the best things that can that you can put in right now. Short term bonds, right? Not even long term bonds. Long-term bonds which have a higher duration, they are much more sensitive to the interest rate. And so we are expecting another interest rate hike in June, which means that the long-term bonds will still see a loss in their values, right? Because they are already invested, right? They're already invested at one particular rate, and the newer bonds are coming up with a higher rate. And so the ones with the lower rate will see a erosion in their value. So long-term bonds and gilts will also see erosion in their value. So our best bet is to place your money in short-term bonds. Okay, short-term debt or short-term bonds, because short-term bonds can reinvest quickly at the higher rates. So if you're investing in mutual funds, then you are investing in short-term bonds, ultra short-term bonds, money market, money market funds, and so on. So those are for less than 1 year to 2 year period, right? And they can reinvest quickly. So they reinvest at a higher rate. When they reinvest at a higher rate. So that is what is the best scenario right now, but not in long-term bonds. Don't put money in long-term bonds or gilts, because they will see erosion, because we are expecting at least one more rate hike. So in the equity market also, there will be a negative impact due to greater allocation towards the bonds. So money will be pulling out of the equity market, and there will be higher credit cost for the companies. So the companies which are trying to put money into their business, and if they are trying to borrow some money, there will be higher credit cost for the companies. So that is going to affect their operational profits, and they will have a higher interest outgo, because of which their cost structure will also be impacted. So overall, it is a pretty negative sentiment all over the place. It is essential for us to maintain asset allocation and navigate this time carefully. That's the thing that is to be done. Now, for those who are interested in putting money into the equity market, you don't for your investments, you don't expect to see any kind of a substantial return over the next 1.5 year, I think. Okay, at least 1 year. No, there will not be any kind of substantial return, because the market will be range bound. It will move, like it is moving right now. It'll come down, it'll go up, and then again it will come down. It'll move in a range bound fashion. But there will be once this phase is over, then it will give us a further rally. So by that time, what you want to do is that you want to systematically allocate money to the equity market, not in one go, but systematically you want to allocate money over the next 1 or 1.5 years. That's what you want to do. Systematically allocate your money. Don't put everything at one go, but systematically allocate your money into the equity market, and over the next 2 years to 3 years, you will see decent returns happening in the equity market. That's what you want to do as a investor, right? So for the short term, put the money in short term bonds and systematically allocate it to the equity market. Don't put lump sum monies systematically over the next 1.5 year. You want to put money into the equity market, right? So this is the action that we want to do. This is the action. In the equity market, you want to select defensive or value stocks, right? Defensive or value stocks. So those stocks that are undervalued right now, and they have a high cash flow and low debt companies. Okay, this will be mostly blue chip companies, or mostly companies which have very high dividend, or companies in the FMCG sector. So those kind of companies which have a very high cash flow, those are the companies that you want to stay in right now. Those are the those are the companies that you want to stay in right now. Suresh, I don't know what this is. Vanguard short-term investment grade fund. I think it is some kind of ETF outside of India. Okay, maybe I'll check it out. I haven't heard of this. I'll check it out. Vanguard short-term investment grade fund. Okay. Let's see. I can check it out, and maybe in a later session I can tell you what it is. Okay. Right. And you want to also look out for companies which have recently repaid their debt. Okay. If there is a company that has recently repaid their debt, then they are sensible people, because before the interest rate is rising, they have cash on their accounts, and they are using that cash to repay debt. So those are sensible people. Those are the kind of businesses that you want to look at. You want to look at high cash flow companies. You want to look at low debt companies. You want to look at companies which have recently repaid their debt, and you want to look at value stocks, and defensive stocks and value stocks. In the minds of people, mostly they'll be high dividend yield companies, or sectors that have not been in the limelight as of now. In the debt market, like we already discussed, invest in shorter term bonds and debt funds. Don't go for long term bonds. Invest in short term bonds and slowly allocate to the equity market. That's the overall picture, and the action that you want to do. About the equity market, we already talked about defensive value stocks, high cash flow stocks, low debt companies. Look out for companies which have recently repaid their debt. And also, if you're parking some money in the debt market, you want to put them in short-term bonds or debt funds, right? And if you have any debt on your books, this is a good time to prepay. If you have cash with you, you have debt on your books, this is a good time to prepay, because any interest that you save, is also money that you earn. So that's the overall picture in how to navigate this 1 or 2 quarters, next 6 months in the high inflation scenario. Yes, the government, let's say RBI has acted late. Many people have this opinion that RBI has acted late, but not in 2020. Maybe they should have done it before a couple of months, I think, because the Federal Reserve in the US, they were already saying it for, I think, at least 3-4 months. I think again and again they were repeating it, that we are going to raise, and it was very planned, and they did raise, right? So, but once they raised it, and then suddenly we come in and we also raise it. So it was kind of knee-jerk reaction this time. But you're right. But it was always expected. You could expect it. The kind of inflation that was happening, interest rate had to rise, sooner or later, and so we can expect it to happen again in June, right? So it has to. Their inflation has to be controlled, and therefore you can expect a rate hike again in June. And probably it is also because of the LIC IPO. But then again, you can't explain how in the middle of the LIC IPO they again came up with this unscheduled announcement. So it's kind of mystery, but that's what it is. We have to live with it. and this is the way which I think that we can. Yeah, once the US has raised, so then we are forced to raise. We are forced to raise because the government bond, the yield on the government bonds, the spread will become narrow. And in that, if the spread becomes narrow, the foreign institutional investors will pull out money quickly from the market, right? So that spread has to remain, and therefore then we also have to raise the interest again. Right, gradual raise would have been definitely better. It's what it's better than giving shock to the market, definitely. But this is what we can expect, going forward, as sensible investors. This is what we can expect, and it is going to go high again. And another 6 months will be a difficult 6 months to navigate. uh, we can try and do the best that we can, right? So yeah, that's what I wanted to say. For this is a short session, and do connect with me for anything related to mutual funds or equity stocks or insurance or portfolio management, any kind of training or mentoring. The website is capitalworx.in, www.capitalworx.in. Thank you very much. That's my email, and that's my link tree and the website. You can connect on any point that you're comfortable with. Any more questions? If we can answer it, or else. Reducing interest, no doubt. If you get reducing interest, no doubt about it, reducing interest. But nobody is giving reducing interest these days. What they're it's not. I think it is not reducing interest. What they're giving is floating interest, right? So floating interest means as the interest rate rises, it will rise. When the interest rate falls, it will fall. So flat interest, definitely not at this time. No, not flat interest, but because you'll be in this bracket for the entire tenure of the loan. So not flat. Okay, right. So thank you very much. Thank you for joining, and thank you for making it interactive. And I hope this is helpful. We'll see you soon on Wednesday with the chart analysis program. Bye. Good day.